Welcome back to Investing Talk Podcast.
Today we're looking at Datavault AI, or DVLT. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we look at Datavault AI, we are basically looking at one of the highest stakes plays in the tech market right now.
Yeah.
The company presents this classic, almost painful conflict. You've got explosive revenue growth versus, well, truly staggering operational losses.
I see those headline numbers, and yeah, the contrast is stark. You have to ask immediately, is this a growth rocket or just a black hole for capital right now? Because the P&L, it tells a story of really aggressive spending.
It absolutely does. Let's start with the upside. The good news, the revenue growth is robust and it's accelerating. We saw $2.67 million in 2024, which is a very strong 28.37% jump over 2023. And maybe more importantly, if you look at the trailing 12 months, the TTM revenue, that number's already climbed to $4.44 million. So they are clearly getting platform adoption, penetrating the market quickly.
That's respectable growth for a tech disruptor, definitely. But then, like you said, we look at the cost of that growth. 170% increase in net losses year over year. That's, well, it's alarming.
Alarm is probably the right word. Net losses for 2024 were negative $67.73 million. And the TTM net income, even worse, at negative $68.61 million.
Wow.
This isn't just, a rounding error. This is the company essentially betting the farm on future dominance. This massive burn rate signals they are intensely prioritizing scaling aggressive market entry and developing that future-proof infrastructure over any near-term profit.
You're trying to build an empire, like right now.
Exactly. And the costs reflect that ambition.
Okay, so that's $68 million figure. It isn't going into, cheap marketing campaigns, presumably. What specifically is driving that huge expense? Is there a genuine technology edge here that justifies sinking that much cash?
Yes, that's the argument. The money is being spent on building a substantial defensible moat, mainly through technology and infrastructure. They're strategically positioning themselves across the highest growth, most difficult niches in tech: data management, analytics, data ownership, privacy, and crucially, high-performance computing, HPC, and supercomputing.
Can you just quickly ground us on why HPC is such a high-cost area, just for anyone not familiar?
Certainly. HPC requires massive, often proprietary infrastructure. It's designed to process huge volumes of data incredibly fast. Think of it as the foundational plumbing needed for things like Pox financial modeling, weather simulation, advanced AI training.
Right, the really heavy lifting.
The heaviest. DVLT is building proprietary software and IP aimed at managing and monetizing that data, creating what they call an IP fortress.
An IP fortress, okay.
Yeah, they've aggressively developed their intellectual property portfolio. It now surpasses 70 patent filings. And this is crucial because it protects their position in what we might call the tokenomics economy, that emerging structure built on blockchain and digital asset ownership. If they own the patents on how data is managed, transferred, and valued in this new digital ecosystem, well, that IP could be worth vastly more than their current revenue. That's the strategic thinking behind the cost structure you see.
Okay, that context definitely helps explain the huge expense. But we still need some concrete evidence that this investment is translating into real traction, right? Not just theoretical potential. What are the recent strategic wins that validate the spending spree?
Right. The validation is coming through some pretty elite partnerships. First, there's the strategic partnership with Max International AG. They're launching a Swiss digital exchange together.
I remember that news.
Yeah, that news alone triggered a sudden 22% jump in the stock price. It highlights the market's belief in their global digital asset ambitions.
And then there's that major capital infusion for the supercomputing side. That detail was particularly interesting.
It was, for a few reasons. They secured a massive $150 million seed investment from Silex. Now, what's fascinating here is that the investment was made in Bitcoin.
In Bitcoin, okay.
Yeah. So this isn't just capital. It signals a long-term sort of decentralized commitment. And it potentially hedges their substantial capital against traditional fiat depreciation, aligning them really deeply with the future of digital assets.
And what's that $150 million actually targeted for?
It's specifically earmarked for developing their high-performance computing and supercomputing capabilities, specifically things like quantum simulation and 3D digital twins.
Digital twins, like a virtual replica.
Exactly. If you imagine building complex systems for high-value industries like, say, advanced manufacturing or defense, they need a perfect digital replica to test scenarios. That's what a 3D digital twin is in this context. It's infrastructure for the world's most complex, highest-value clients.
And they aren't just building this stuff in a vacuum either. I saw they're leveraging established players, which must provide immense validation.
Precisely. Their AI agents, DataScore and DataValue, they're now being commercialized for the enterprise sector. And these agents were built in partnership with IBM using watsonx.ai.
IBM, okay, that's a big name.
Huge. IBM contributed engineering resources and $5 million in technical support. When an established giant like IBM puts its resources and its name on your product, well, it drastically accelerates adoption across major sectors like finance and healthcare.
Okay, right. So we've established the growth is real, the spending is strategic, even if huge. But before we get totally sold on the vision, we have to look at the financial stability or maybe the lack thereof. We're looking at a high-risk situation here, and what's available or not available on the balance sheet makes that risk seem even greater.
This is where we hit the absolute biggest caveat, really, and why extreme caution is warranted. We have pretty good P&L data. Growth metrics are clear. But the absence of key balance sheet transparency is, well, it's striking. What's fascinating here is that, as of now, there are no verifiable standard sources for cash on hand, debt levels, current ratio, or free cash flow. We just don't have those numbers reliably.
So we know the engine is powerful, but we don't actually know how much fuel is in the tank or how much the car is mortgaged for. Is that a fair analogy?
That's a perfect analogy. We are effectively buying a high-performance car with the hood welded shut. This lack of detailed balance sheet visibility, it's the single greatest risk component here. It means investors are really buying a vision and an execution thesis, not audited financial stability.
Okay. Given that immense uncertainty, what are the immediate events that could move this stock over the next few months? What are the catalysts we should be watching?
We've got 4 major near-term drivers. The first critical date is November 14, 2025. That's the scheduled next earnings report.
Right around the corner.
Exactly. The market is keenly focused on continued top-line acceleration. If they show strong sequential quarter-over-quarter growth, the stock will likely react, well, violently. Could be up or down.
And the management team itself is setting some incredibly aggressive goals around revenue, aren't they?
Beyond aggressive. Management has signaled massive projected revenue guidance that almost defies logic. They are targeting between $12–15 million in revenue just for the second half of 2025.
12 to 15 million in 6 months.
Yes. And looking into 2026, their targets exceed $40–50 million. If they hit even the low end of that 2026 guidance, it basically validates the entire high-cost strategy.
That huge revenue forecast is definitely fueling the current optimism, no doubt. But they also have operational changes happening immediately, right? An acquisition.
Yes, a planned acquisition that was previously postponed is now expected to close around November 15, 2025. This is a cash-funded integration, and it's supposed to prioritize immediate growth synergies, expanding the customer base. We need to watch how smoothly that integration actually goes.
Okay. And finally, you mentioned a date for just external market movement.
Right. Mark it December 18th, 2025 on your calendar. This is when the S&P small cap and various ETFs do their quarterly rebalancing.
Yeah.
Given the stock's high volatility and its increasing market cap, inclusion or exclusion could significantly impact liquidity and institutional fund flows. Big money moving in or out.
Okay, let's pivot then to the technical landscape. All this confirmed news, plus the speculative buzz, it must make for a very volatile chart.
Oh, it's a textbook example of volatility.
Yeah.
The price swing over the last year alone is incredible. It's moved from a low of just 0.251 cents up to a high of $4.10.
Wow.
It's currently trading around $3.42. That's massive relative outperformance compared to the broader market.
And short-term traders are definitely treating this like a bit of a casino based on recent action.
They absolutely are. We saw a classic 2-day whipsaw just recently. Plus 4.24% rally, immediately followed by a minus 5.14% correction the next day. That signals speculative traders piling in, chasing the headlines, and then just as rapidly taking profits. It creates a really choppy environment.
So what are the critical levels traders should be watching as we approach that November 14th earnings date?
Well, short-term support seems to be holding pretty strongly around $2.91. If that earnings report disappoints, that level will be tested immediately, no question. Conversely, The overhead resistance is clearly that annual high of $4.10.
So the anticipated trading range driven by these catalysts is pretty tight then, between, say, $2.90 and $4.10.
Yeah, that seems to be where the immediate focus is.
Okay. Now, despite the volatility, the stock is highly liquid, which is actually good for larger institutional funds looking to maybe get in, right?
Exactly. The market cap sits around $603.5 million, which is decent. But the average daily volume is over 82 million shares.
Yeah.
That is exceptionally attractive liquidity. Makes it easier to build or exit a position.
And there's a fascinating detail about how the stock moves, or rather doesn't move, compared to the rest of the market, the beta.
Yes, this is critical for anyone thinking about portfolio construction. Its beta is quite low at 0.39. For listeners maybe unfamiliar, a beta that low means we essentially ignore the S&P 500 when looking at DVLT. This stock trades almost entirely on its own idiosyncratic news. The Max International deal, the Silex investment, that November earnings report, that's what will dictate movement, not general market sentiment. It's a completely self-contained story, for better or worse.
Speaking of self-contained stories, what about market sentiment? Is the street actually buying into this narrative? I see the one analyst covering it rates it a strong buy.
The conviction appears high, yes. But there's a huge, kind of weird footnote attached to that analyst rating.
Oh.
They rated a strong buy, highlighting bullish conviction, okay? But they set a price target of $3.
$3. But it's trading at $3.42 now.
Exactly. That target is currently below the market price.
That's a massive red flag, isn't it? Or at least confusing. It suggests their conviction might not truly match the market's current enthusiasm, or maybe they think a correction is imminent before it continues its climb.
It definitely requires scrutiny, yes. It certainly adds another layer of, well, skepticism or confusion. However, if you look at the short interest data,
The short sellers, what are they doing?
they seem to be changing their tune. We saw a significant reduction, about 78.3% in short interest by the end of October.
Wow, that's a big drop.
It is. That suggests short sellers are getting nervous and covering their positions, likely ahead of these November and December catalysts. They don't want to get squeezed if there's good news.
Okay, so we have confirmed growth, confirmed very high spending, confirmed partnerships, and some nervous short sellers covering. Now let's pivot to let's call it the speculative buzz. How much of the current valuation is based on confirmed facts versus just pure market chatter and rumors?
Yeah, a lot of the recent spike seems built on that chatter. The core growth story is solid, but the rumors definitely add jet fuel. Market chatter exists, for instance, about a potential Fortune 100 client adopting their AI-powered exchange very soon.
A Fortune 100 client would be huge validation.
Massive validation of their enterprise penetration, absolutely, if that comes true.
And following that successful Swiss deal, there's talk of more global expansion, right?
Rumors are pretty thick regarding pending global exchange joint ventures, possibly in Asia, maybe other European markets, leveraging the architecture they've already built. Furthermore, because of that massive recent $150 million capital expenditure.
The Bitcoin investment?
Yeah. There's speculation about an early quantum computing product announcement, maybe ahead of schedule.
Quantum computing. Wow. And government contracts. Any whispers there?
Yes, unconfirmed discussions are circulating regarding a potentially major licensing deal or even a government contract for their patented data monetization tools. Again, these are strictly rumors, but if even one or two materialize, the stock could go parabolic.
But if they don't materialize?
Then we're relying solely on that confirmed, albeit high-risk, growth trajectory and management execution.
Okay, let's just quickly reiterate those two primary risks that all investors absolutely must acknowledge before touching this stock, putting aside all the rumors for a second.
Right. First and foremost is the sustained net losses and the resulting capital dependence. Burning $68 million a year means they must constantly secure external financing or hit those massive revenue targets immediately. The high valuation demands they keep raising capital, which almost inevitably dilutes existing shareholders over time.
Okay, risk number one, dilution and needing cash.
Risk number two is operational execution risk. Plain and simple. The company's current valuation hinges entirely on management, not only delivering on rapid customer acquisition, but actually hitting those enormous $40–50 million 2026 revenue targets. Failure to meet guidance, even by a small margin, could lead to a severe, painful repricing downward.
So bringing it all together, what does this all mean for someone considering an investment in Datavault AI right now? What's the final thesis synthesizing all this risk and reward? Well, the overall rating we're seeing is generally bullish, scoring around an 8.0 out of 10. That strong score is really driven by that verified high growth, the powerful secular trends in AI and data, and that long list of imminent catalysts we talked about, scheduled over just the next 3 months.
But tempered by.
Tempered significantly by the critical risks, those sustained losses, and importantly, those severe financial disclosure gaps on the balance sheet.
So what's the best time horizon then? Who is this stock actually for, given that dichotomy?
It seems clearly attractive for short-term traders, people looking to capitalize on that intense news-driven volatility, specifically around the November 14th earnings report and that expected M&A close around the 15th. That is a pure, like, 3-month horizon play based entirely on events.
Okay. And for longer-term folks, it is also potentially very appealing for long-term investors. Those who are fundamentally betting on multi-year data transformation trends and the value of that IP fortress. Provided, and this is absolutely essential, provided the path to profitability becomes much clearer sometime in 2026. This requires real conviction in the management team's ability to execute flawlessly under pressure.
Sounds like a high wire act.
It is. The aggressive strategic moves, that massive revenue guidance, it all suggests Datavault AI is truly betting the farm on becoming a dominant player in data monetization. The real question for investors isn't just if they can hit the $40–50 million revenue target in 2026, but how quickly they can shift from burning nearly $70 million a year in losses to actually generating sustained free cash flow. Yeah. That right there is the ultimate test.